The most common thing I hear from business owners at this time of the year is, what should I be doing before June 30? And I'm going to give you that list in this video because there are genuine things you can do right now that will reduce your tax bill. But after doing this for over a decade, I can tell you that the checklist is kind of the easy part. The thing that actually separates the business owners who consistently pay less tax from everyone else is one conversation most people don't even know they can have with their accountant. So I'll walk you through 5 things that will make the biggest difference before June 30, and then I want to show you what that conversation actually looks like, because it's the same process I run with most clients. All right, so let's start with the stuff you can actually do right now before June 30 that will make a difference. Number 1 is superannuation contributions. For the 25-26 year, you can contribute up to $30,000 in concessional contributions and have it count as a tax deduction. Just to clarify though, that $30,000 cap includes any super already paid as part of your wages. If you want to take advantage of this, there are 4 things you needed to do. First, work out how much super you'll already be contributing through your wages by 30 June. And then secondly, decide how much extra you want to put in, depending on your cash flow, up to that $30,000 cap. Third, you make the contribution and the money needs to actually land in the super fund before June 30. So don't wait until the last minute. And fourth, lodge a notice of intent to claim with the super fund. That's basically a fancy form that says you want to claim a tax deduction on that contribution. If you skip that step, you don't get a deduction. Number 2 is bringing forward any expenses you are going to pay anyway. Anything you're planning to spend money on in the next, say, 12 months, you can pay for it before June 30 and claim a tax deduction this financial year. The rule's pretty simple. If you use it within 12 months, you can normally claim it now. So that includes things like insurance renewals, software subscriptions, training courses, equipment upgrades, or travel that's already been booked in. The action point here is this: call your providers, get them to issue the invoices early for the prepayment you want to make, and then make the payment before the deadline. Number 3 is the timing of your invoices. If you're a service-based business and you've got work that's not going to be done until July, don't invoice it in June. If the work is actually happening next financial year, the income belongs in next financial year. This isn't about gaming the system or anything. It's about making sure the income lands in the right period. You have to be genuine about it though. You can't just sit on invoices for work you've already done. Number 4 is trust distributions. I get it, despite a lot of negative press recently, trusts are still one of the best ways to save tax as a business owner. The key is you need to use them correctly. For most trusts, the trust deed, which is the document that says what the trust can and can't do, requires you to decide how you want to distribute the profits before June 30. And when I say before June 30, I mean before June 30, not when your tax return is being done. There was actually a case where the ATO proved that the resolution, the decision on who gets what, wasn't made before the deadline, and the trustee got hit with tax at the highest marginal rate. So the action point for you is to work out with your accountant now to figure out how to distribute those profits from the trust in a way that gives you the best tax outcome. You most likely won't know the exact profit number yet, but the decision on who gets what percentage needs to be documented before the deadline. Check your trust deed for the deadline and have a chat to your accountant. Number 5 is your director's loan account. This one's less of a tax saving strategy compared to the others on the list, but if you've been handling it incorrectly, fixing this can save you a lot of money. Director's loans are one of the biggest causes of nasty tax surprises for business owners. The money you take out of a company needs to be either a wage, a dividend, or put onto a formal loan term with principal and interest. If this is handled incorrectly, the ATO treats those drawings as an unfranked dividend, which means you're paying tax on it personally on money that the company has already paid tax on as well. That's basically like the same dollar getting taxed twice. Not good. If it's handled correctly, however, and combined with something like a trust, you could actually turn the situation around and end up with a refund. So the action point for you is this: if people have been drawing out money from the company, i.e. you, the business owner, and it's been going to your loan account in the books, talk to your accountant about how to deal with it before June 30. Now, those 5 things are worth doing every year and they'll save you money, but they're only one part of tax planning. The real value in the tax planning conversation is when someone steps back and looks at the whole situation about your business performance, your structure, what you're planning to do over the next few years, and works out how all those pieces fit together. So What does that actually look like? Let me explain. Your accountant really does two types of work for you. There's compliance, which is your tax returns, your BAS, your lodgements, the stuff that has to be done, and the value of it is pretty straightforward. It keeps you on the right side of the ATO, so it's pretty valuable. But then there's everything else, which is all the value add stuff. And for most business owners, everything else doesn't really happen because they may not know what to ask for. Not because it can't, but because nobody's asked for it. Tax planning is one of those services. It's where your accountant gets to look beyond the tax return stuff. And yes, it covers how to reduce your taxes, but it also gets into how the business is actually performing and whether there are profitability issues that need attention, what's happening with the family structure, and whether there are other services you're going to need in the next 12 months that nobody's talked about yet. It's the one meeting where everything gets put on the table. It's the difference between your accountant taking off their get the tax return done hat and putting on their how do I actually save you money hat. It's where they get to look at red flags in your business performance. For example, maybe your gross profit doesn't look right, or if you're running a service-based business, your utilization rate, which is how much of your team's available time is actually being billed, is sitting lower than it should be. It's where they get to map out what your tax bill looks like if you do nothing and then show you what the options are. It's where conversations about your longer term plans actually happen. Like, what are you doing with the money in the business? What does the next 5 years look like for you personally? Most business owners I speak to for the first time tell me the same thing. They want more from their accountant, they want strategy, they want someone to be proactive. And when I've asked if they've ever had a dedicated tax planning meeting, the answer is almost always no. So when I sit down with a client for tax planning, there are 5 things we go through. The first is business performance. Before we even talk about tax, I want to know how the business is actually going. We pull the profit and loss up to the end of March and we look at it properly. Is the revenue tracking where we expected? Are there expenses that have blown out? I'll give an example. For an allied health clinic, we will look at the utilization rate across the team. I've had clients who had no idea a team member had actually been sitting at a 60% utilization for 6 months until we pulled the numbers together for the meeting. The second thing is the tax outcome if we do nothing. Based on where the business is tracking right now, if we make 0 changes between now and 30 June, here's what the tax bill looks like. I want my clients to see that number in April because that's the baseline. Every decision we make from here is about improving that number. Number 3 is the longer term picture. And this is where the conversation goes beyond the financial year. I'll ask the client what they're planning to do with the money in the business. Are they looking to buy a property in the next 12 months? Are they looking to plan to hire a new team member? Because that could change the strategy completely. If someone's applying for a loan next year and we've reduced their taxable income too aggressively this year, the bank sees a low profit and won't lend to them. The fourth thing is where we map out the actual options. This is the part most people think of when they hear tax planning. Can we distribute profits through the family trust to family members on lower income who might need the money? Does it make sense to put more into super beyond what's already going through on your wages? Are there asset purchases we should be bringing forward? Should we use a bucket company? Here, we will make specific calls based on what we've already seen in the numbers, what the structure allows for, and how much profit we're actually working with. The fifth and final thing is dealing with red flags. Remember those director loan accounts I mentioned earlier? This is the meeting where that gets caught. Same thing with things like if the books are messy and needing a bookkeeper to be involved before next year, or the structure you set up 3 years ago not fitting anymore because the business has outgrown it. This is where all of that gets put on the table before it becomes a problem. Now, if you're watching this and June 30 has already passed, don't worry, you haven't missed everything. The things that do close off are things like super contributions needing to land in before the deadline, asset purchases needing to be done before 30 June. Those windows are shut. But everything else still kind of applies. Your tax return normally isn't due until March to May the following year, so you've still got up to 11 months to really set aside funds if you haven't been doing it throughout the year. And the biggest thing that business owners hate is a bad surprise at tax time. Knowing the number early, even in July, gives you enough runway to plan for it. And that's the good news. You can still have this tax planning conversation with your accountant. The 5 things I just walked through don't expire on June 30. You can still look at business performance, still map out what the structure should look like going forward, deal with red flags before they get worse. The only difference is you're planning for the financial year ahead instead of the one that just ended. And honestly, that's where the real value sits anyway. Action point for you. If you don't have a tax planning meeting booked with your accountant this year, call them, ask for one. On that note, if you found this helpful, like, subscribe, and we'll see you in the next video.